Hi, I'm Ryan Pierce, and I'm going to be presenting Crypto 101 today. Now, I currently co-chair the Fixed Digital Asset Working Group, and I also chair the DTI Foundation's Product Advisory Committee, and I serve as a expert member on ISO TC68 SC8 Working Group 3. So here's a bit of an overview of how I'm going to go through this info. I'm doing this in kind of an interesting way that I'm not entirely sure other people are covering, because a lot of presentations cover the hows, but I'm trying to cover the whys. And so that means going through some theory, some computer science theory, some economics, some politics behind why a lot of the things are done the way they are in digital currency and digital assets. And I'm going to start by talking about the first use case, which is Bitcoin, a digital currency, talk about why it's very difficult to have a decentralized digital currency and how Bitcoin solved those problems. If there's anything that you take away from this presentation, I hope that it's pertaining to the nature of trust and how trust is really redefined in this digital revolution, and how decentralization poses unique challenges and provides some solutions here. I'm going to be talking a bit practically about Bitcoin, talking about some of the philosophy behind cash versus store of values, discuss the other digital currencies or altcoins that exist. Then I'm going to go into detail to talk a bit about blockchain and distributed ledger technology, which is the underpinning technology and how this works. I'll talk about alternatives to proof of work or mining and private blockchain, and then kind of start diving into use cases, such as how blockchain can be used beyond digital currency, some of the advancements that have been made, smart contracts. And as we know, there's a lot of hype around blockchain. I kind of want to try to cut through that with my own opinion on the use cases and anti-use cases for blockchain technology. I'll then give sort of an overview of, as it exists now, how I see the digital asset landscape and where Fixed Protocol fits into that. So let me just get started. First off, I want to talk about what a digital currency is. And I'm going to posit that digital currency is not new. It's existed as long as almost as long as computers have existed. And that almost all currency in existence right now actually is digital today and was digital long before Bitcoin was invented. That's because there's a lot more dollars that exist solely in ledgers at the Federal Reserve than there exist US dollars, for example, in circulation that are printed. So Fedwire, ACH, Visa, MasterCard, PayPal, all of these things are examples of digital currency. Now, I know that a lot of people are going to say, now wait, that's not what I think of when I think of digital currency. I think of Bitcoin, I think of Ether, and yes, that's because the two that I mentioned, what I mentioned before, are relatively easy. And the new cryptocurrencies are hard. And the reason that those previous examples are easy is that first they use fiat currency. Now, fiat currency is a term that refers to currency issued by fiat by a government monetary authority. The United States says that a dollar has worth. Therefore, we believe it. They also have to place absolute trust in a central party to maintain a ledger. So when I spend money with my credit card, I am trusting Visa to make sure that I'm only billed once. And if Visa decides to act dishonestly and bill me multiple times and refuse to correct that, I've got a big problem on my hands. But that generally doesn't happen, and I can trust that they are going to administer my credit card account fairly. Now, once we try to eliminate either of these two constraints, we suddenly move from an easy problem to a hard problem. And I will argue that Bitcoin is the first successful digital currency that was able to overcome both of these constraints. And the blockchain technology that Bitcoin uses really has a lot of amazing opportunities and potentials that I'll be talking about. And that this is pretty much a revolutionary way of thinking about finance and technology because it changes the nature of trust. So for digital currency to be successful, it's my opinion that there are 4 factors that it has to have. It first off has to have guaranteed scarcity. Currency does not have value if it isn't scarce. If I can produce as much of it as I want when I want, well then how is that really currency? Are people going to assign any value for that? I mean, I can't just say styrofoam peanuts are currency and try to pay you in styrofoam peanuts and expect you to accept that. So there has to be a mechanism to produce scarcity. Second, because digital currency, cryptocurrency specifically, exists out of nowhere, it's just plain created. And there has to be a way to distribute the newly created digital currency fairly that users believe in and can support. So if I were to create Ryan Coin today and say that all Ryan Coin goes to me and then I'll start selling it to you, are you going to consider that as valuable? Probably not. But there has to be a way that people can, that the digital currency is considered fairly created and distributed so that people will actually want to use it. The third point is really critical, and that's prevention of double spending. So somebody who spends money can't spend it a second time. With physical cash, this isn't a problem. If I hand you a $20 bill, it's gone. It's out of my wallet. I can't spend it to somebody else. But in a digital world, how can you enforce that? And the person receiving the money needs a verification mechanism that the money was successfully sent and that they actually now own it and that the person who sent it can't double spend it with anyone else. And the fourth point is decentralization, and that's elimination of trust in a central party. And this, not all digital currencies have this, but I think that this is generally important for overall success, which is that the digital currency needs to exist independent of its inventor. The reason for that is that one can attack the currency by attacking the central party if there is one. So by eliminating the central party, you eliminate a point of attack on it. It also reduces the liability for the central party that's operating the currency. And I'd like to give you a bit of a history lesson. Back in the late 90s, a company called eGold created a digital currency. It was not a cryptocurrency, and it existed very simply. People would give them bars of gold. They would put them in a vault. They would issue digital currency to them. They would issue on a ledger that they maintained. And it was a traditional database application that they as a company maintained. They also kept the gold bars in the vault. The gold currency in circulation equaled the gold in the vault, and people could then send digital gold back and forth with each other. And that has almost all of the problems solved there. It's guaranteed scarce because gold is scarce. It's fairly created because only the people that put the gold bars in the vault get the currency initially and then they can sell it. You can't double spend it because there's a database that only allows it to be spent once. But it was centralized. And so previous to 9/11, the definition of money transmitter did not include this type of operation. However, in the United States, new regulations on money transmitters went into effect after 9/11, and that put eGold into some serious trouble. and the US government came after them, and it ultimately collapsed in 2008 when the US government charged the inventors or charged the operators of this for criminal actions that were taken using eGold, even though the operators of it themselves had no involvement in those particular actions. And ultimately, it was settled, and they had to hand over a significant amount of their gold reserve to the federal government, and the whole thing went under, which is kind of sets the stage for why, if you have one central party, that party can be attacked. If you have a decentralized system, it becomes harder to attack. So now I'm going to go through I'm going to try to create a simple model of a computer science problem referred to as the Byzantine generals problem. And if I could have have two volunteers from Fix join me, please.
Hi, Ryan.
Hi, how are you all doing?
Good, thanks.
Very good, thank you.
Okay, so here's what we're all going to do. We need to pretend that all three of us are generals in the Byzantine Empire's army. Now, we are all seasoned military commanders. We've all been given an army, and we've been told to march on London and surround the city of London, and if possible, attack and capture London. If we don't think it's a good idea, if we think London is too well defended, then we retreat and go back home. So now, en route, we decide that the way we're going to do this is we're going to vote. After we've surrounded the city, we each send out our scouting parties, take a look at how well defended London is, and we use our military expertise to make a reasoned decision on what the best course of action is. And there's three of us, so the best 2 out of 3, whatever we decide is what we're going to do. And it's important that all 3 of us do the exact same thing, because if all of us attack the city, that's good. If all of us retreat, that's fine too. If some of us attack and some of us retreat, then London, the people who are attacking are going to be outnumbered. The London armies will kill them and then come after whoever's retreating and go and take out them as well. So we don't want that to happen. We want to have a consensus on what we're going to do. So we're all going to vote, but it's a bad idea for all 3 of us to be in the same place. So we're each going to have 3 one-on-one conversations. So you figured out what you want to do. I'm not going to listen. Amy and Naomi, please chat amongst yourselves and decide what you want to do, and record your own vote and the vote of the other person.
Okay, so I think I'm going to vote yes, that we should attack London.
Yeah, I'm not too sure. I think we should retreat, gather the troops and think about it.
Okay.
Okay. Now, Naomi, don't listen. I'm going to have a chat with Amy here. So, Amy, what do you think? What do you think we should do here?
I think we should go for it and attack London.
Great idea. I like it. Fully in support. I'm voting for attack as well.
Okay.
Okay.
Great.
So, Naomi, what are you voting on doing here?
I'm going to retreat still. I just don't think it's a good idea. I think we're not prepared and it's too well defended.
You know, I think you're right. I'm going to vote for retreating. Now, notice what just happened here. You see, what I didn't tell you is why this is called the Byzantine generals problem, because the Byzantine Empire was rife with corruption, treason, backstabbing, and all over foul play. And I am a bad actor. I didn't tell you this, but I'm a bad actor, and I'm trying to subvert this voting process. So now, what has just happened? Amy, what is your vote tally?
My vote says that it's 2 to attack London and 1 against.
So first thing in the morning, what are you going to do?
I'm going to attack.
Okay, and Naomi, what does your vote tally say?
Mine is 2-1 for retreat. So I'm going home.
And so very bad things are going to happen tomorrow morning because we were able to subvert the because I, as a bad actor, was able to subvert the consensus. Even though I'm in the minority, there are two of you that are honest and one of me that isn't. I was still able to subvert this process. So thank you very much.
Thanks, Ryan.
So the Byzantine generals problem, how does this relate to digital currency? And it turns out that preventing double spending is really a form of the Byzantine generals problem. So let's say that there are two different ledgers, and one ledger believes that the consensus is that Alice paid Bob, and the second ledger says the consensus is that Alice paid the exact same coin to Carol. Well, now what could happen is that Bob and Carol both might sell Alice some goods, thinking that they've been paid if Bob looks at ledger 1 and Carol looks at ledger 2. But yet only one of them has been paid, so one of them is going to be defrauded, and Alice has just now successfully done what's called a double spending attack. And so that's what the Byzantine generals problem is designed to solve. Now, it's difficult, really difficult, to get a consensus if you consider that most of the participants involved are going to be motivated by self-interest. They're not altruistic. They won't always do what's right. They will do what is economically and practically in their best favor, in favor for them at the time. And when you have some participants that are going to be malevolent no matter what, and you can't just trust one third party to take care of it. If we had a trusted third party, that trusted third party could have tallied our votes and we wouldn't have had this problem. But because we tried to decentralize this without a trusted third party, that's where we ran into some trouble. And this is a really hard problem to solve efficiently. And Bitcoin arguably is the first digital currency that was able to solve this and was able to be implemented on a wide scale. So now I'm going to change gears and talk about Bitcoin. So it was launched in 2009 by an unknown entity that referred to themselves as Satoshi Nakamoto. It could be a person, a collaboration of people. There's a lot of speculation. People have come forward claiming to be Satoshi. Nobody knows who Satoshi is, for sure. And Bitcoin itself is a digital currency, and it's not issued by any government. There is no government says that Bitcoin is a fiat currency. It's also not backed by assets either. No one's holding dollars or euros or gold anywhere backing Bitcoin. It's very much like cash in that it's a bearer instrument with no recourse. So if I send you Bitcoin and you don't deliver goods to me that you promised, I can't do anything at all about it. I can't physically compel you. Versus if I sent you a wire transfer and it turns out that fraud had occurred, I might be able to get the wire reversed from the bank. Or if I had a credit card, I could do a chargeback. That's not possible with Bitcoin. Once Bitcoin is sent, it's gone. If it's sent to an incorrect address, it's permanently gone and nobody gets to have it. Bitcoin is also pseudonymous. And I want to clarify, it's not anonymous. Every transaction is associated with a pseudonym, effectively an address. And so those addresses don't have obvious names. But if people can tie names to those addresses, then transaction history can be revealed. So it's like having a pseudonym. It has a decentralized peer-to-peer network. There's a whole network of what are called Bitcoin nodes that communicate with each other and exchange the ledger and exchange pending transactions, etc. And it's implemented on something called a blockchain that's a decentralized ledger with no central trusted party that maintains it. The network collectively maintains it and comes to consensus on it. I'm going to have to pause that one and talk about that in detail, how that works later. But yeah. So now, how does it stack up against my 4 criteria? Well, guaranteed scarcity. There's a limit of 21 million Bitcoin that was hard-coded ever since the first Bitcoin was created. It was stated that there would only be 21 million Bitcoin ever. 50 Bitcoin are mined or created every 10 minutes. And every 4 years, that number halves. So currently, 6.25 Bitcoin are created every 10 minutes. Now, for fair creation and distribution, I'm going to talk more about what miners are, but miners invest computing power securing the Bitcoin blockchain. And they are rewarded with the newly issued Bitcoins and transaction fees that are attached to the Bitcoin transactions. So there's a financial incentive for people to mine. And what's really kind of revolutionary is the economics here, that Satoshi was able to solve the problem of fair creation. He didn't give all the initial Bitcoin to himself and sell them to people. He used them as incentives to contribute computing power to secure the Bitcoin network. The blockchain also prevents double spending and eliminates trust in the central party, and I'm going to talk about why later. So here's a graph of the historical price of Bitcoin. This immediately makes my presentation obsolete, given that it was around 35,000 when I recorded US dollars when I recorded it, and it's probably not going to be when you watch it. As for how Bitcoin is used, Bitcoin is not something, this is one thing I hear a lot, that people are like, oh, Bitcoin gets stored in a wallet. No, it's not stored anywhere. Bitcoin is stored in the blockchain. The blockchain is a ledger that says what addresses can spend what Bitcoin. And you don't have to store, and you don't store your own Bitcoin. What you as a user do is you have a wallet that stores public and private cryptographic keys. And those keys are what you use to spend Bitcoin that have been sent to your addresses. So your wallet is how you interact or how you hold your Bitcoin. Now, wallets can be implemented in software. That has a drawback, though, because if you have your Bitcoin wallet on your laptop and a hacker breaks into your laptop, if they search your laptop and find your Bitcoin wallet, if they can also get if that's encrypted, they can get the password for that, they can then take all of your Bitcoin and you have no recourse. So security around this is very important. Some companies have created dedicated hardware that just holds Bitcoin keys, so that the Bitcoin keys themselves never actually have to go onto a consumer laptop that could be potentially attacked. So there's custom hardware wallets as well. It's possible to have cold storage or offline storage. You can even print out your keys on paper, delete them off of computers, and put them in a safe deposit box, so to try to reduce the risk of theft. Also, if this is too complicated for you, you can trust an exchange or custodian to hold your Bitcoin for you, but it should be noted that you are then dependent on their security practices and their insurance if their security practices fail, if there is even insurance. There have been a number of very well publicized exchange hacks that have occurred in the past, where people on exchanges have lost, in some cases, significant amounts of Bitcoin. So how does one get Bitcoin? Well, it could be mined, but that's really difficult. Most people aren't going to do that. It could be purchased on an exchange, or it could be received as a payment from another Bitcoin user. Bitcoin, well, as I said, was like $35,000. It's not very usable for small purchases. It can be subdivided down to 8 decimal places. Now, these Bitcoin transactions, if I wanted to send you Bitcoin, the way that I would do it is I'd first have to authorize it by creating a transaction record that is signed using the private key that I have in my wallet. I then take this transaction and I broadcast it into the Bitcoin network, which widely distributes it to all the miners. Now, everyone on that network can trivially and quickly validate the digital signature and validate that those funds, that those Bitcoin haven't been spent before. And assuming that that transaction is valid, then a miner will take it and include that transaction with a whole lot of other transactions and put them together into a block and do proof of work, which I'll talk about, and publish that block out onto the network. That block is then accepted as truth, and it becomes permanent part of the public ledger. And so now if I'm sending you Bitcoin, you can just watch, you don't have to hear anything back from me. You just watch the ledger passively, and you all of a sudden will see that a block in the ledger was added where there's a transaction giving you those Bitcoins. So that means you can now spend them and that you are the owner of them. So that's how transactions, Bitcoin transactions, work on a blockchain. But most Bitcoin transactions are actually the buys and sells that happen on individual crypto exchanges, digital asset exchanges. Those typically are never recorded on a blockchain. If I want to buy, or if I want to sell Bitcoin, I would do a blockchain transaction to send Bitcoin from my wallet to the exchange. The exchange now has an omnibus account. They're holding my Bitcoin, and I have a ledger entry on the exchange's database. And if I sell Bitcoin to another user, that's just a ledger entry on the Bitcoin's on the exchange's database, not on the blockchain. And that same Bitcoin can be traded around a whole lot. And it's only when somebody wants to withdraw it to their own wallet or move it to another exchange that a blockchain transaction has to happen. And that's important because the blockchain has limited transaction processing capability, but the transactions on an exchange could never keep, the blockchain could never keep up with all the exchange transactions, which is why these things are separate. In the same way, I mean, likewise with securities, typically a lot of times securities typically end up netting in a batch over, and there's a batch overnight of ownership changes, and that kind of is comparable here. And I mentioned kind of before that wallet addresses, if they can be linked to people, they destroy anonymity. And there's a lot of talk of Bitcoin as a good, perfect thing for criminals. No, it isn't. Because that same blockchain that keeps transactions secure for honest people is also an evidence locker that secures proof of wrongdoing for dishonest people, and it's public. So if all you have to do, if you're law enforcement, if you grab a criminal and you find that they have a Bitcoin wallet, once you know their Bitcoin their Bitcoin addresses, you can now link that to every other criminal they've done business with, and you could then prove a lot of things. So, for instance, there was a very notorious case of the Silk Road, where the owner of the Silk Road website claimed that, yeah, he set it up, but he left before it was used for trading illegal drugs. And the feds got a hold of his Bitcoin wallet, and they were able to then get a hold of the Bitcoin wallet on Silk Road, and they were able to prove conclusively that millions of dollars, or like over $1 million, was sent from the Silk Road to that one person. And that right there, they didn't even need a search warrant for that. If they wanted to go after its banking records, they'd have to have a search warrant. But here it's completely public. So using Bitcoin for criminal activity is probably not a very good idea at all. So now there's a debate over what really should Bitcoin be used for. And I'm not going to weigh in on this. I'm going to present both sides. This is incredibly controversial within the digital currency community, because there are some people that believe that the purpose of Bitcoin should be to act as cash, and that You should be able to transact with Bitcoin freely, just like you would US dollars, and you should be able to use it as a replacement for fiat currency. There are other people who say that no, Bitcoin should be a store of value, that it should be like the equivalent of your savings account, that you don't generally buy a pizza or a latte out of your savings account. It's for long-term storage of value. And what this is reflected in is transaction fees, because initially, when Bitcoin was created, there was a maximum limit of the number of transactions in blocks. And there were not a lot of, there was no real competition. It was very easy to get your transaction into a block because there was excess room. Well, that changed as people started using Bitcoin. And so there's a market approach for determining transaction fees. And I kind of liken it to, if I were to go to a restaurant and you have a lot of people in the restaurant, only you have to write on a sign above your table what percent you are tipping the waitstaff. Okay, wait a second. In the US, tips are actually very critical. I know it's not common in other countries, but anyway. So if I write that I'm willing to tip 15% and everyone else in the restaurant is tipping 30%, and there's limited wait staff, they're going to service the 30% customers before they tip before they were going to serve me. So there is sort of so every Bitcoin transaction includes the ability to give an optional tip to the miners who are mining the transactions. And those really are no longer optional because there's so much transactions that want to get into the blockchain. The miners prioritize it based on who's tipping highest. And so as a result, the transaction fees, which used to be negligible or on the order of pennies, at one point, even earlier this year, spiked as high as nearly $60 just to get one transaction on the Bitcoin blockchain. When I wrote this, it was down to around $5, although even within the previous few weeks, it was as high as 20. So these numbers fluctuate based on supply and demand. But what it means is it's impossible to use Bitcoin for cash for small purchases right now. You can't buy a latte or a pizza with it because you're going to spend more on the transaction fee than you are on the latte or the pizza. So there has been proposals to extend the blockchain to be able to have more transactions fit in it. And there's competing interests here, and it's a very difficult conversation. There's also been what's called talk of moving transactions off of Bitcoin, and I'll get to that later. So now Bitcoin is not the only game in town. There are other digital currencies, sometimes called altcoins. Bitcoin still is by far the biggest. Again, this is completely making this lecture slide deck outdated when I say that Bitcoin was at 687 billion with a B in US dollars in market cap, and it occupies the #1 slot. But there's thousands of others. So the #2 slot is held by Ethereum, which is 200, I think, small print in my computer, I'm sorry, 287 billion in Ethereum. And Ethereum is special because it supports what's called smart contracts. I'm going to talk about that. And it also supports user-created tokens using something called ERC20 that I'll talk about. So the whole idea is now I can create my own tokens for whatever purpose I want, and I can have them ride on top of the Ethereum network, and they're just as secure as Ethereum itself. The #3 slot at 62 billion is USD Tether. Now, Tether is what's called a stable coin. And a stable coin is something that is backed by stable reserves of something else, such as a fiat currency or gold. And in the case of USDT, as its name suggests, it's backed by one USDT. And the idea is that one USD Tether has a price of exactly $1, and it can be bought and sold and used in place of US dollars. It's widely used to move funds between exchanges, because let's say I want to arbitrage between digital currencies on two different exchanges. I can move digital currency between two exchanges relatively fast, but how do I move fiat between those two exchanges? If I have to use something like ACH or Fedwire, that could take a long time. USDT moves like a cryptocurrency. It is a cryptocurrency, and it moves like one. It can move fast, and so people use it as a way of moving digital currency around between exchanges. And it's interesting because if you look here at the 24-hour volume, you'll note the 24-hour volume, at least as of when I made the slide deck, was 76 billion versus the market cap of 62 billion. So there are more USDT moving per day than there are USDT that exist. There's also Ripple, which is actually it's slightly off of this graph, but Ripple or XRP uses a consensus algorithm that doesn't involve mining or proof of work, and it allows creation of arbitrary assets such as bank deposits in USDT or euros, and it effectively can act as an interbank bridge currency and as a way of supporting foreign exchange without going through traditional means. I'll talk a little bit more about that later. I mentioned Zcash. That has enhanced privacy using technology called zero-knowledge proofs, and that allows for potentially far higher levels of anonymity in transaction. Unlike Bitcoin that can be traced by pseudonym, Zcash uses zero-knowledge proofs to therefore make Bitcoin to make its digital currency non-traceable. And Dogecoin is currently in the number, at least when I made the deck, in the number 6 slot in terms of market cap. And okay, it was created as a joke. This tells you something about the state of digital currencies, that its mascot was a meme of a really cute Shiba Inu dog that talks in bad grammar and Comic Sans. And okay, all I can say, it's really cute, but a joke was able to be worth 42 billion in market cap. So now let me talk about the blockchain and how this is all implemented. So a blockchain is a decentralized ledger. It's a list of blocks in order, and each block contains transactions such as I sent you 2 Bitcoin. And it also consists of a header, and that header includes the cryptographic hash of the header of the previous block. And that's where the name blockchain comes from, because each of these consecutive blocks form a chain, one after the other, and each block is linked to the previous block because it has that block header's cryptographic hash. That block has cryptographic hash of the previous block all the way back to the beginning or Genesis block. The blocks also have a hash of all of the transactions in the current block. It's referred to as a Merkle root. There's also a timestamp, and there's a number in there called a nonce that is exceedingly difficult to compute. And by exceedingly difficult, I'm talking about on the order of like winning a lottery jackpot. And why this becomes secure is partly because of that difficulty of computation. So let's say that I want to fraudulently modify a transaction in the blockchain. Well, for me to do that, I would have to just changing one digit on a transaction would invalidate the hash or Merkle root of the transactions in that block. And if I were to fix that in that block, that would then make that block have a different header. So every other block after that no longer would link to the block that was there. Effectively, every block issued almost cryptographically signs the entirety of all transactions back to the beginning of Bitcoin. And so the longest blockchain that's valid is considered the truth, the actual truth that people have consensus in. And so miners now spend a whole lot of effort working competitively to try to generate these blocks by trying to compute a valid nonce that makes a block valid. And when they do that, they publish it out to the network, and then people work on the next block. And this is something called proof of work, and it presumably guarantees security. And now, if I, as a bad actor, want to rewrite history, I am going to need more computing power than all of the existing miners combined, because I would need that in order to compute a sequence of blocks that promote my alternate form of history, so that I could create a chain that's longer and get ahead of the other miners, and then publish that out and have everyone accept my version as truth. So in order to rewrite history, I need more computing power than all of the other miners in the world that are mining right now. And that's what's referred to as a 51% attack. Two other points. Because it's so rare to mine a block, people that mine generally work collectively in pools. So the idea is that it's almost like pooling for a lottery, whereas a bunch of people all contribute into the pool, and whatever ticket wins would be shared by the entire pool. So if I'm running a miner and I happen to mine the block, I don't get all 6.25 Bitcoins. That's split evenly among everyone in the pool who is mining. But ultimately, that's actually to my best interest, because I probably will never be able to mine a Bitcoin block in my life. But if I want to be paid for mining, I need to do computational work. So that's how mining pools are how mining is generally done. And as I said, blocks are issued approximately every 10 minutes. Well, there's something called a difficulty factor. And so after 2 weeks of 10-minute blocks elapse, the network looks at the timestamps and recomputes a difficulty factor of how difficult or hard it is to mine the next 2 weeks worth of blocks. And so that difficulty dynamically adjusts. When more miners start mining, then they mine blocks faster. The difficulty level rises, making it slower to mine them in the next 2 weeks. If people stop mining, then it's going to take more than 2 weeks to mine that many blocks. The difficulty factor lowers, and it becomes easier to mine. So is proof of work secure, and are there alternatives? Now, advocates for this argue that the economic incentives are aligned, and that's what guarantees the security. That miners have to invest considerably in custom hardware. You cannot mine Bitcoin with a normal computer. You have to have a dedicated miner. And here is an example of a miner for digital currency. And this thing can only mine Bitcoin. It can't even mine Ethereum. It just mines Bitcoin and other coins that use the same proof of work algorithm. It definitely isn't a general purpose computer. And so miners these things aren't cheap. Miners are in an arms race to get mining hardware that is faster than their competitors, And they have to spend a lot of money on the hardware. They spend money on the electricity. So it's believed that they would have a vested interest in the long-term value of the digital currency, and that it is more profitable to mine fairly than it is to try to do a 51% attack or to try to acquire enough computing power to attack Bitcoin. And so far, for Bitcoin at least, it's worked. There was a close call in 2014. One of the mining pools briefly acquired a little bit more than 50% of the mining power. And that panicked a lot of people because everyone then realized, wait a second, that mining pool potentially could rewrite history. So miners left that mining pool to other pools, and the problem very quickly corrected itself. And so at this point in time, no party controls enough mining power to do any kind of attack on Bitcoin. It's possible that altcoins, though, that are mined with the same hardware could become vulnerable to these 51% attacks, and it's happened in the past. Now, miners legitimately look at the difficulty of mining other altcoins, and they may switch from mining Bitcoin to mining an altcoin if that other altcoin would be more profitable for them to mine. And that's perfectly legitimate. But it's also possible that bad actors may decide that have a substantial amount of mining equipment, may decide to stop mining, let's say, Bitcoin or whatever the primary coin is, and use their hardware for nefarious ends to do a double spend attack on another blockchain. And in that case, they're going to lose out on whatever they could have mined fairly, but they're going to gain on the double spend. And that's probably going to cause the price of that altcoin to crash. So they might also short the altcoin to try to make some more money. And when that's all done, when their scam's finished, they can take their miners and put them back to work mining the original coin. So there are economic examples. If an altcoin does not have a lot of miners working on it and is valuable, it may become the target of such an attack. And Bitcoin Gold was hit with double spend attacks in 2018 and 2020. Ethereum Classic was hit with a double spend attack in 2020. So they are possible, just they haven't been done in general on the largest, the primary digital currencies for each method of proof of work. So it's coming, proof of work is really coming under fire because of its impact on the environment and the economy. Now you can see right here what the problem with mining is, okay? Look at the size of those heat sinks. See these big, huge fans here? That tells you that this miner takes a lot of electricity to run. And a lot of electricity is consumed worldwide mining, and that means that there's greenhouse gas emissions relating to it. Also, the chips in that miner are not normal stock computer chips. They're custom designed chips. And so semiconductor fabricators their capacity is going to produce these chips and which effectively drives up the price of other chips. Also is the question of e-waste. You notice that miner, the fact that I showed it to you means that it's not plugged in and it's not mining. That tells you it's obsolete, because if it were not obsolete, then it would be plugged in and mining right now. But right now, it's basically good for nothing but a doorstop. So this is sort of arguments against mining. Also, some digital currencies were designed to prevent people from using that type of hardware to mine them, and they are most efficiently mined using computer graphics cards. Well, guess what that's done? If you want to buy a high performance computer graphics card, you're now competing with people to use it for graphics purposes. Like, let's say you want to play games or do CAD work, you're competing with miners who are driving up the price and making those things scarce. But why is it needed? And this sort of gets to the why question. The truth is that if we could just find a way of fairly dividing the work of mining among everybody who wants to mine, we wouldn't need proof of work. The only time you run into a problem is if one party can collectively mine a lot of consecutive or close to consecutive blocks. That's when a 51% attack can happen. If you could distribute it among individuals that are not colluding with each other, you don't need proof of work at all. So why doesn't everyone just take a turn? And that gets to what's called a Sybil attack. Now, Sybil was a patient that had multiple personality disorder. I think she had something like at least 16 independent identified personalities. And there was a book written about her. But the internet, because the internet is effectively anonymous or pseudonymous, I don't know if I love the 1993 New Yorker cartoon, on the internet, nobody knows you're a dog. Well, that's kind of true. Nobody knows who you are on the internet. So if Sybil were on the internet, each one of her personalities could claim a different account, and people think they're dealing with 16 different people when they're really dealing with one person. And so that is the problem inherent in this, in that if you blindly trust anybody who wants to be a block validator, and if you blindly trust that they're independent and you are decentralized, then you're vulnerable to this kind of attack, which is why it was never done, which is why Satoshi Nakamoto created proof of work to prevent Sybil attacks from working. So there are alternatives. One of them is called proof of stake. In this case, validators are pledging assets that they own. And in order to validate a block, the right to validate a block is awarded based on the percentage of the staking pool. So if I'm holding 2% of the staking pool, then I should be mining 2% of the blocks. And the idea is that it would make it very expensive for a bad actor to amass 51%, to mine 51%, or to validate 51% of the blocks. In order to do that, they would have to put up 51% of the staking pool. And by acting in bad faith, they may actually lose their stake. Some systems have financial penalties to discourage bad actors. So some tokens like Ethereum and Zcash are working, at least in their roadmap. They want to move from proof of work mining to proof of stake mining. There are other tokens that are out there that are already proof of stake. And the idea behind proof of stake, though, is that just a simple computer you don't need a miner, you don't need custom hardware, you don't need to do a lot of calculation. You just need a computer that's sitting out on the internet that whenever it's chosen to mine a block, will mine a block. That's it. You don't have lots of hardware or expense or electricity or hardware involved. So that could take care of some of the environmental concerns. Now, Byzantine fault tolerance, though, is not in any way a blockchain issue. The late 1970s is when people started thinking about Byzantine fault tolerance. And even aircraft and spacecraft control systems are designed around Byzantine fault tolerance, not because they believe there's bad actors on them, but because if some weird malfunction caused the autopilot of a plane to think, caused the flap sensor to tell the autopilot that the flaps are down, but lit the cockpit light that said that the flaps were up, that would be catastrophic. And so algorithms were created to handle Byzantine fault tolerance. There's something called PBFT, for example, that is Byzantine fault tolerant, The trouble, though, is that these algorithms typically are vulnerable to Sybil attacks. And that's why proof of work, Nakamoto consensus, and proof of stake can solve the BFT problem in environments where Sybil attacks are possible. There's also Ripple that uses a hybrid model where anyone can join the consensus process and you don't need proof of work hardware for it, and there are no mining rewards. But the way they get around that is by having each node that's part of the consensus process have a unique node list. And each node is not going to accept a new version of a ledger unless a supermajority of the unique nodes say that it's valid. And that thwarts Sybil attacks, because if our fictitious Sybil decided to add 1,000 validating nodes to the Ripple network, and they were all going to collude to do bad things, as long as people didn't recognize them in the unique node list, then they wouldn't be able to subvert the network like that. And that gets me now to private or permissioned blockchains. And these are very interesting because you hear in the financial industry of a lot of consortiums creating what are called private blockchains or permission blockchains. Now, are these blockchains mining? No. The participants in them are not doing proof of work in general. Or if they are, they're doing it in a small nominal capacity. And the network gets its security because there's a fixed membership list. So if I'm part of an industry consortium that I know has 9 other members, and each of us has 1 node connected to the network, then I should see 10 nodes validating. And if one party, the permissioning prevents one bad actor from adding an additional 15 nodes to try to take over the consensus process. So this is really ideal if you know who the people you're trading with are. But you don't necessarily trust them, but you know who they are. You can then set up a private or permissioned blockchain, and you can use a Byzantine fault-tolerant protocol that doesn't require proof of work or proof of stake. So therefore, the members are running the nodes. They don't have to have hardware. They don't have to buy expensive hardware, and the system is kept secure against one actor performing a Sybil attack and outnumbering everybody else. It is also, but it's not going to be secure if a supermajority of the actors collude with each other to do something bad. But in industry consortiums, usually economic incentives and fear of legal and regulatory action generally help prevent something like that from occurring. So now blockchain does not necessarily have to be used with digital currency. And a lot of people early on started thinking that the digital currency was just a flash in the pan, and that the real value in all of this was blockchain, and that all of the financial industry would convert over to using blockchain. And well, that hasn't exactly happened, but it's still disruptive technology that I want to look at. So the idea here is that a blockchain is a ledger, and it doesn't have to use a newly created digital currency. You can also use a blockchain to record traditional assets. You can use it to move fiat currencies. You can use it to record stock ownership or bonds, gold deposits. There are numerous pilot projects to record titles to real estate on blockchains. They're also useful for provenance and supply chains. So, for example, tracking vegetables from the grower to the store shelf. So if there is a recall that needs to happen, if it can be traced, it then knows which vegetables and which store shelves need to be thrown out, and you don't have to throw out all lettuce in the United States. by comparison. And it prevents bad actors from lying about whether they got the contaminated lettuce or not, because there's a blockchain that shows where it's all gone. Tracking authenticity of parts installed in airplanes. So if I'm installing a brand new jet engine and that jet engine has a brand new fan blade, that fan blade could be put onto a blockchain. So if ever there is an incident involving it, the ownership that can be traced, and you can know that Pratt & Whitney or Rolls-Royce manufactured that blade, and it didn't come from some no-name factory somewhere trying to make a counterfeit aircraft blade and selling it for original and pocketing the market when that blade might be unsafe. Things like furtive pilot involving tracking diamonds from the mine to the jeweler, so that way you can make sure that conflict diamonds don't enter the supply chain. It can also be used as a notary to prove that things happened. It can be used to enforce workflow rules to show that a given trade went through a certain life cycle. It can be used for trade repositories. It can be used for regulatory purposes and audits, protecting log files against tampering by hackers as well. If everything is on a blockchain, it becomes hard for a hacker to go in and just delete the log files. If they wanted to create a consistent blockchain or a consistent log file that cover their traces, that would make it more difficult. So advances now in blockchain technology. I mentioned this in the past, but building custom tokens on top of existing blockchains. Because, as I said, altcoins can be vulnerable to 51% attacks. If I want to create a new coin for some novel new use case, I don't want to create my own blockchain if I can absolutely avoid it. Instead, I could use something like Ethereum and then create ERC20 tokens on top of it. And those ERC20 tokens can be exchanged between parties just as easily as the native currency Ether can be exchanged. Multi-signature transactions. This was added to Bitcoin, and you can allow, for instance, M out of N signers are needed to spend tokens. So if I want to create, I can send funds to a address that requires that 2 out of 3 keys have to sign in order to spend those tokens. And that protects me, because if I distribute those 3 keys among independent entities, a hacker would have to hack 2 out of the 3 in order to do something nefarious. If one of the parties decided to go rogue and they controlled one of the keys, they couldn't steal anything because they would need to have 2 out of the 3. And if one of the keys ever were lost for whatever reason, the other 2 people could collaborate to spend it and move it to a different address. So multi-signature is also something that's being looked at. Hierarchical deterministic wallets. This is a way of being able to generate from one sort of phrase a large number of wallets that look independent but are really linked together. And that really simplifies key management, storage, and security. So if I'm an exchange, I can create a new wallet deposit address for every one of my clients. But the system that creates those addresses doesn't need knowledge of the private key to spend it. So the private key can be kept offline and secure. And I can instead use these HDK wallets to generate as many public keys as I want, and that public key generation can be online, and if it's compromised, it's not so bad because they can't be spent. Confidential transactions, I mentioned that. There's a number of proposals and thoughts on how to implement that, possibly so that certain things are on the ledger and they are encrypted, so that the buyer, the seller, the amount, so that only the buyer and the seller and maybe designated parties like a regulator could look at the various fields that are involved, such as the amount of the currency that's being transferred between parties, but there would be a proof done in such a way that even though third parties can't decrypt and see the amounts, they can prove that no funds were created or destroyed in that transaction. And so therefore, they can prove that the transaction was fair, even if they can't see it. Also, interoperability between blockchains. There are things now called side chains. Bitcoin's liquid network is an example of it. So the idea is that you can take an asset and you can lock it on a primary blockchain. You can then transfer it to a second chain, and you can exchange it however you want. But then whoever's holding it on the second chain can then unlock it on the primary chain. And the use cases for that are interesting. Like I said before, some people consider Bitcoin to be a store of value. Well, what do you want to do if you want to do cash? Well, in that case, you can use a side chain, and you can use that where there may be much lower transaction costs to buy and sell a latte, or to buy a latte, or to buy a pizza or something like that, where there are lower transaction costs. And they're even looking at technologies involving microtransactions, where you could watch a movie on demand and you can exchange pennies per second that you watch it. Interledger Protocol is something else that allows exchanges of assets on different ledgers to occur atomically, so that you don't have to trust a third party for escrow. Multiple parties can coordinate to do an atomic transfer where all assets in a trade get transferred or none of them do, without having a escrow agent that could potentially go rogue and steal people's stuff. Smart contracts are another very interesting development. And these although they're not exclusive to Ethereum is what one generally thinks about in terms of, it was a blockchain that was created to be able to run smart contracts. Now, the idea behind a smart contract is that you can take machine code, computer code, you can store that code on a blockchain, and that code can be executed, and it doesn't require trusted third parties to run. So a lot of times this involves sequencing of transactions. Like if I have $1,500 in my checking account and I write out a check to one person for $1,200 and a check to another person for $1,400, depending on the order that those two people try to cash those checks, one of those checks is going to bounce. Well, the idea is that if you store the inputs and the computer code itself on the blockchain, you can then prove execution, and you can also prove sequencing, that this transaction executed before this transaction, which is executed before the next one. And you can do a lot of really interesting things with smart contracts. Now, for them to be useful, they have to be able to exchange things of value. And smart contracts can receive, hold, and send Ether. So you can send Ether to a smart contract, and the smart contract's code determines what happens to it. And this is how custom tokens like ERC20 are implemented. Now, there are a lot of use cases for this. Imagine being able to create a binary option where both parties put collateral in, and when the binary option, whatever event it's triggering on, the appropriate party gets paid. This is nice because you don't have to trust an escrow agent to hold, or a custodian to hold the money from both parties, where that entity could run off with it, could go bankrupt, and it could vanish. With a smart contract, the contract effectively holds it all in escrow, and the code of that contract defines how it operates. Now, that may require using an external entity, which is referred to as an oracle. And the oracle will provide data into that contract. So if I'm trying to do a binary option on whether Bitcoin is over $40,000 at the end of next week, you and I could put our money into that binary option, and we can designate an oracle. And that oracle has to be trusted to give the right price of Bitcoin to that smart contract. And that oracle, if they're dishonest, could lie about the price of Bitcoin. But the interesting thing, though, is that oracle cannot steal either of our collateral. The smart contract holds it, and the smart contract enforces it. You can also have bonds that automatically pay their owners. You could have stock shares that directly implement their voting rights using the blockchain. So it becomes clear and recorded who voted for what, and that's tied to ownership share. You can also have what's referred to as DeFi, decentralized finance. So people are looking into using smart contracts to implement exchanges, insurance, liquidity pools, loans, derivatives, all of these things. And you can even have entities or organizations referred to as DAOs, or decentralized autonomous organizations, where people can contribute money to them, and they have voting rights based on how much they have based on their percent share of ownership. Now, this brings up a really interesting issue, though, which is the question of code is law. And that refers to the idea here is that you do not, with a smart contract, you don't need a judge or a court to enforce a contract, because the blockchain will just run it. And you don't need, there's no ambiguity. You don't need a lawyer or a judge to interpret the contract, because it's all machine code that executes automatically. It also means that authorities cannot void a contract for any reason, unless the code of the contract specifically gives them a way to do so. But it also means that if there's a bug in the smart contract, the consequences could be utterly catastrophic. So, for instance, there was the Dow Hack. And in 2016, $50 million, which is also equivalent of 5% of all of the Ether in existence at the time, was stolen by a bad actor who found a bug in the Dow smart contract code. And that caused chaos in the Ethereum community, and ultimately they decided that they were going to do what was called a hard fork to reverse the transaction and undo the theft. That was a very controversial decision. And some people who believed that code is law, that contract should, if someone exploited a bug in the contract, then so be it. The contract said they could, so they should be able to. Those people objected, and that's how the Ethereum Classic blockchain was formed. There has in 2017, there was another horrible case where $280 million of Ether became frozen permanently when a bad actor broke a popular multi-signature wallet. They found a way of doing something on the blockchain that caused all 280 million to become unspendable and inaccessible. And to date, the Ethereum community has not, to my knowledge, reversed that. So that money is just basically gone. So that's sort of the catch of smart contracts. Yes, code is law, which is good if you want it to be enforced no matter what, but it's bad because it's going to be enforced no matter what, even if there's a bug. Now, there's a big hype cycle around blockchain, and people often say that blockchain is a solution in search of a problem. And people are, I'm sure you're familiar with the emerging tech hype cycle, and all new technologies go for hype, where people think that it'll do everything, including make a better mousetrap and walk your dog for you. I mean, I've personally heard pitches from startups that have, well, we'll do X, but on a blockchain. And the trouble is that there are blockchain. This is my opinion now. I mean, all this is my opinion, but this is really subjective in my opinion here, which is that blockchain and distributed ledger is the world's worst performing and least tested database that exists out there. And it also has the highest development costs, because if you want to hire a database architect and a database programmer, you can do that. Hiring a blockchain architect, blockchain developer, those price tags go way up because there aren't as many of them. Most applications, though, don't have a distributed trust problem, in my opinion, that warrants a blockchain. And I said at the beginning of this talk, if you take anything away from this, it's all about redefining the notion of trust and decentralization. Trusted central utilities are not necessarily bad. Now, there's a caveat on that. Commerce has worked this way for millennia. You can go back to cave people, and you pick a trusted third party where they can give people to. I mean, the concept of escrow has existed for millennia, and so in a lot of cases, if a central authority makes sense or is efficient, then it's probably best to use them. Also, in cases of recourse, blockchain typically does not offer recourse, and people may want that. If someone steals my credit card and takes my money, I like knowing that I can call my bank and my money is going to come back to me. With a blockchain, it's gone. So now where this can, and in cases where parties, blockchain, in my opinion, only really makes sense when you have parties that don't trust each other to keep the master database or source of truth. And they can't decide upon a mutually trusted third party to keep that master database for everybody. Either that party doesn't exist or it wouldn't be sufficient. Those are the cases where blockchain may be a good solution. So, for example, if you have companies doing business in different countries where they don't expect fair treatment in each other's court systems, a blockchain might be good. Competitors that don't trust each other, that want to work together on a collaboration, but they don't trust each other, and they don't want to create a central utility because one doesn't exist, and if one did exist, it might become too powerful and could threaten them. That's another good case. Likewise, recording of real estate deeds in former Soviet republics. These are places that have historically had high levels of official corruption. This isn't just theoretic. I know people who have relatives in Ukraine who basically had somebody bribe the equivalent of their recorder of deeds to lose the deed to real estate for a home that they've occupied, or property or land that they've occupied for a long period of time. And what do you do in a circumstance where officials are bribable and a deed could get lost or be replaced? In that case, a blockchain is great because you can't just lose a deed. There is a record that's permanent on that blockchain. And so if somebody tried to do something funny, there would be a record of it. And that would at least provide some semblance of being able to try to get a fair solution. But at the same time, I live in Chicago, and my home, the deed for my home is recorded on a blockchain. I think that's a complete waste of money and resources and time, because I have never in the United States heard of people having their deeds lost or having county recorders bribed in such a way that a blockchain would actually fix a problem with real estate titles. So I think that was a blockchain use case that doesn't make sense, but yet people do it. And again, there's the hype cycle. You put the word blockchain on it, and all of a sudden, investors' ears perk up. So I think there are good use cases, and I think there are not good use cases. So now, getting to the digital asset landscape. I've already touched on digital currencies and cryptocurrencies. Total market cap on these things peaked at nearly 2.4 trillion US dollars. The prices on these on digital currencies and cryptocurrencies often are not correlated with other asset classes. So they're great for trading, for people that are traders that are seeking alpha. Regulated derivatives on cryptocurrencies exist. And there still, though, is a lot of regulatory uncertainty. The US in particular is really bad about this in terms of flip-flopping or issuing conflicting advice over, is something a digital currency, in which case it's a commodity, versus is something a security. And case in point, there is an SEC lawsuit against Ripple, trying to allege that Ripple was an unregistered security. And that had a chilling effect in the US, because if you are a digital currency exchange and you're trading Ripple, all of a sudden you could be viewed as trading an unregistered security, which could cause issue with the SEC. Also, the US SEC has not to date, to my knowledge, approved a Bitcoin ETF. Of course, look at the date on the presentation. This could change at any time. So there isn't a good way for non-accredited investors who don't want to hold or have another person have custody of their Bitcoin. There's no good way for non-accredited investors to get exposure through the capital markets. So now you have tokenized assets, sometimes called security tokens. These are digital representations of things like stocks or bonds. And it's interesting, usually these things are products that actually are regulated, that are trying to be offered under various rules by national regulators. The question, though, is, will tokenizing these assets give any real benefit relative to the existing systems in place for handling them? Initial coin offerings or utility tokens, this has typically, in the past, ICOs were incredibly popular for startups. And the idea is that a startup issues what's called utility tokens. So if that startup is going to provide a service, the utility tokens would be what that startup would use to pay for that service. So if I wanted to buy that service from the startup, I would buy the utility tokens. And the idea is that the startup, though, may not have the service ready. By buying them now, that provides funds to pay the startup to do the initial development. That's where things start to get dicey, because the US SEC is considering this as an unregistered security. And there have been a lot of lawsuits relating to, and enforcement actions relating to ICOs, where ICOs, the companies claim that they are not securities, that they are just used for a particular utility and that purpose alone. And the SEC is claiming that they're really speculative securities after all. Okay, there's also non-fungible tokens or NFTs. These have made the news recently. I'm going to be honest, this is my own opinion. I personally don't like the NFT craze. The idea, though, is that all of the tokens I've talked about in the past are fungible. In this talk have been fungible. So every one Bitcoin is identical to any other Bitcoin. The idea behind a non-fungible token is that you can create a one-of-a-kind token that corresponds to a single collectible asset, such as a work of art or something like that. And the question, though, is that these NFTs are often tied to something that's digital and can be reproduced infinitely, yet has one owner according to that particular, only one owner can own the NFT. So the idea is that this somehow makes that ownership of that valuable. But again, I really question its value. I mean, what does it mean to buy and own a tweet? Or what does it mean to buy a meme or a video clip or a digital image if that thing is infinitely shared out on the internet? So this is an interesting point. There's a lot of conflicting opinions on that. Now, I've mentioned stable coins as well. So they track a stable asset. They can be backed by the asset itself, and that also can be controversial. There has been a lot of speculation in the news about the nature of the assets backing USD Tether and whether every USD Tether is backed by $1, or could it be backed by etc. So there's some questions around that. And there have been audits. People have tried. I'm not going to get into whether USDT is backed or not, but they purport to be. And that's one way of making a stablecoin, is to have a company issue it and say that it's backed by the asset that it represents. There also have been DeFi ways of creating stablecoins using algorithms that work almost like a monetary authority, that try to control the price by controlling the supply. And so they can buy back the coins if they become too cheap, they can increase the supply if the coins become too expensive relative to the asset, buy them back, etc. And the idea behind stable coins is they can be used for reducing volatility, and they can also be used to facilitate payments or movement of fiat equivalent between exchanges. And again, payments are one of the use cases that happen here. There's talk also around central bank digital currency. And the idea here is, what if central banks got in on this? And in that case, that would be interesting, because a digital currency would have the stability and legal tender status of fiat currency. And a lot of countries are investigating this, and China is in the process of rolling out the digital yuan. The question, though, is that a lot of the properties, blockchain was largely created. Bitcoin could be viewed as being created by crypto anarchists who didn't want government control over currencies, and blockchains are designed to be censorship resistant, designed to be either anonymous or pseudonymous, and a lot of those features really go against vested interests that governments have in AML, ATF, etc. So it's questionable whether central bank digital currency, how fully they're going to embrace use of the blockchain. And this space is constantly evolving. So I imagine in the future this is going to be out of this. There may be things to add here. It's in the future. So now, where does Fix Protocol fit into all of this? Well, Fix has a digital asset working group. I'm co-chairing it, and we are working on adding digital asset trading into the Fix protocol. Fix is already multi-asset class. It supports a massive variety of asset types, and we want to extend Fix to make it easy for people use it to trade digital assets. We're working on a buy side to sell side guide and an exchange guide of best practices that would indicate how exchanges can implement this. And we are going to need to do a gap analysis to change the fixed standard, to add small numbers of enumerations and tags to fix in order to support the workflow. But I don't anticipate a lot needs to change because fix is already very well designed for multi-asset spaces. Now, one of the things that we identified early on is that symbology is a problem, because all of these things are decentralized. There isn't necessarily an official that's in charge that can make definitive statements about them. So if I want to know what is a share of Microsoft stock, I can go to an exchange, and the exchange says that this stock is Microsoft Corporation. I can go to Delaware and see that the corporation is registered there, and I can then find their registered agent and their place of business, and I can ask them for their board records of when the stock was issued. There's national numbering authorities that assign a specific ISIN, for example, to a stock, and that doesn't exist for digital currency. And it even is a problem because I mentioned the whole cash versus store of value argument with Bitcoin. Well, people created a fork of Bitcoin called Bitcoin Cash. But at one point, there was a concerted effort to try to state that Bitcoin Cash was the real Bitcoin. And who defines what the real Bitcoin is? This is difficult. So the idea here is that we need a symbology that can be used internationally, and this is where FIX worked with ISO, International Standards Organization. And the 24165 standard, the ISO 24165, is the Digital Token Identifier, or DTI standard. I was personally appointed to the working group that created this and helped author it. It is a unique random fixed length identifier for digital tokens that will address the lack of standard symbology. I mean, I remember in the digital asset working group hearing a bit of a cautionary tale where two crypto exchanges merged with each other, and they had a problem because both of the exchanges used the same ticker symbol for two different digital currencies, and they had to sort that out. Well, if you had a DTI, that could be the primary key for your own security master database. So even if two exchanges have the same ticker, they're going to have different DTIs, and you can correlate everything by DTI. This standard is in its final stages of approval. There's a soft launch expected in the second half of 2021, and we want FIX to be able to support this symbology. And there's a huge range of potential use cases for this. I mean, buy sides, sell sides, exchanges, end customers could use it, custodians. Also, regulators are an interesting area too, because as any market emerges, the one thing that's constant is regulators step up and they say, we want transaction reports. We want to know what's happening in this market. And if regulators are going to require reports from exchanges or et cetera, or even tax authorities are going to require reports, how do you identify these digital assets? Well, the hope is that this is going to be the international standard way of uniquely and unambiguously identifying a specific digital token. Also, depending on interest, FIX may be looking at the post-trade settlement and custody message flow for digital assets as well. So that's it for me. I think that this is definitely game-changing, and I hope I've been able to help provide some clarity and some insight and answer both the what questions and the how questions and the why questions relating to digital currency and blockchain and digital assets. Thank you very much.